Hello, how to perform consolidation when you acquired a subsidiary that does not constitute a business but is a group of assets. So in this video, we are going to learn it step by step on a practical example, and we are also going to learn a theory behind it. I am Sylvia of cpdbox.com, and for more articles, examples, Q&As, and other similar stuff, please visit my website. Let me read the case. Mami Corporation acquired 80% share in Baby Limited on 31st December 2002 for 80,000 currency units. After careful assessment, Mami concluded that Baby does not constitute a business and serves only as a carrier of assets. It has no liabilities and all assets are shown at their fair values. Prepare Mami Group's consolidated statement of financial position at 31st December 2002. And here we can also see the balance sheet of both Mami and Baby. So looking to Mami, we see the investment in Baby amounting to 80,000 currency units. And when we look to Baby, we see no liabilities, only equity composed of share capital of 85,000 and retained earnings loss of 5,000. And that may represent some expenses required to maintain the property, who knows. So this is indeed very simple balance sheet. Usually you would see some cash or bank accounts or small liabilities in there, but for the purpose of this video, we keep it absolutely simple. So before we start with the example, let's actually see what the standards say. IFRS 3 business combinations applies only when an investment constitutes a business, and IFRS 3 contains a guidance on what the business is, but we are not going to deal with it here. So this transaction is out of scope of IFRS 3. However, we have the standard IFRS 10 that requires preparing consolidated financial statements for each subsidiary and even for those who do not constitute a business. Yes, there are some exceptions, but not being a business is not one of them. So you do need to consolidate. How? You're going to apply different procedures from those when you acquire the business, of course. In fact, they are prescribed in IFRS 3, and it asks you to account for such a subsidiary as for an asset acquisition rather than full consolidation. And this means that you need to allocate the cost of the group to individual assets and liabilities of acquired subsidiary based on their relative fair values. And then it also means that there is no goodwill. No goodwill, okay? The thing is that if you paid more than the fair values, this excess is a part of that allocation in step 1, not a goodwill. And we will show that in the numerical example. And finally, if you acquired less than 100%, you have non-controlling interest, and that is always measured at fair value, never at a proportionate share, which is a very common method used when you work on the full consolidation of a typical parent-subsidiary relationship when there is a business involved. So here, non-controlling interest measured at fair value only. So let's take a look at our example. I place the two balance sheets together, one next to each other. And now the first thing what we do is to calculate the cost of the group, which is the sum of the consideration transferred and non-controlling interest acquired, measured at fair value. So Mami paid 80,000 and that comes here into consideration transferred. What about non-controlling interest acquired? Yes, there is some, because Mami purchased just 80% share for 80,000 currency units. Therefore, non-controlling interest is 20%. But what is the fair value of it? Well, we don't know, and really you should apply IFRS 13 fair value measurement to measure this fair value. But for the sake of simplicity, let's assume here that Mami purchased 80% at its fair value of 80,000. So if 80,000 is fair value of 80%, then logically the fair value of remaining 20% would be 20,000. Of course, that might not be the case in reality, because Mommy acquired controlling share and it might have paid a premium amount for the control that would not be included in the non-controlling interest valuation. So please do not assume this is automatic. I am using the simple method here to illustrate. Fine. So the cost of the group is 100,000. We need to allocate it to the cost of assets and liabilities acquired relatively based on their fair values. Okay, so the question said that baby's assets were at their fair values. So let's do the allocation. To investment property, we allocate 70,000 divided by total assets of 80,000 multiplied with cost of the group of 100,000. And this comes to 87,500. And to machines, we allocate 10,000 divided by 80,000 multiply with cost of the group of 100,000. So this is 12,500. Now we can do our consolidation entry. Here the first step is not to combine Mommy with baby because those are not the right numbers, all right? Instead, we debit property, plant and equipment with 12,500. This is the amount allocated to the machines. We debit investment property with 87,500. This is the amount allocated to investment property. Then we credit Mommy's investment in baby of 80,000 to get rid of that in consolidation. And then we need to recognize the non-controlling interest acquired at its fair value of 20,000 as credit in equity. And we then simply add up Mommy's numbers with the entry, and here you go, you consolidated subsidiary that is not a business. Now, we can argue that some assets might be overstated. For example, those machines had fair value of 10,000, but we allocated 12,500 here. So now the carrying amount is greater than its fair value. And to solve this, you should look at the consolidated assets and liabilities and continue measuring them in line with the other appropriate IFRS standards. So for example, here you would need to perform the impairment test because carrying amount is definitely greater than the fair value. So this indicates the impairment. It might not necessarily be there. It could be that the value in use will be greater than the carrying amount of 12,500. So then you're all okay, but you should definitely test. Now, let me just show you quickly how this would look like if baby was a business and you apply the full consolidation method instead. I have worked this example out for you because this is a typical consolidation with goodwill and all that. And I worked this example with applying proportionate share method of measuring non-controlling interest on purpose to make a contrast. So see, I calculated non-controlling interest as 20% of baby's net assets at the acquisition date, which is in fact 16,000 and not 20,000 as valued by fair value before. I could have used fair value too. Then our goodwill acquired comes to 16,000. And you remember that before we did not have any goodwill at all. So let's take a look at consolidation entries. Here we simply added up Mommy's and baby's numbers. So you can see that we are taking baby's assets at fair value to the consolidation and not at the allocated cost of group as before. So the investment property is just 70,000 here, not 87,500. Then we have a goodwill here. Before there was none. And here we have non-controlling interest at the proportionate share. It could have been at fair value. I repeat that. That's your choice here. But before you had to do non-controlling interest at fair value. Unless you're liquidating. I need to say this. If you're liquidating, you can use also proportionate share. But unless you're liquidating, you need to apply fair value when accounting for asset acquisition. Now let me put two consolidated balance sheets next to each other. So you see that they look slightly different. And I remind you again, once you're done with asset acquisition accounting, you should review all the items one by one and see if you need some adjustments like impairment tests. Another example, I would say that investment property would need downward revaluation via profit or loss, because this is definitely stated over its fair value of 70,000, okay? So this is it, the absolutely simplistic example of consolidation when acquired subsidiary is in fact group of assets, not a business. For more videos and lectures like this, please check out cpdbox.com, sign up for our free newsletter. You can like this channel, share it with your friends, because remember that sharing is caring. Thanks for watching.